Last week, the European Central Bank met for their regular monetary policy review. The outcome of that was that they cut rates 0.1% to negative 0.4%, largely in line with expectations. They also tweaked a few other small rates and introduced a facility where they paid banks to borrow money from them and lend it to the real economy. Those were surprises. The biggest surprise, though, was probably the increase in the amount that they're going to spend on bonds every month. The ECB has been buying 60 billion euros of bonds each month. They increased that to 80 billion euros. The market was expecting them to go to 70 billion euros. They also increased the scope of what they can buy. In the past, they've been buying government bonds and covered bank bonds. They can now also buy non-financial corporate bonds. Initially, the market reacted well to the surprise stimulus. The currency depreciated, as you'd expect, when they increased the supply of euros, and risk assets like equities rallied. But as ECB President Mario Draghi started to address the media, that reversed course. The currency strengthened, risk assets fell. And what was happening was that Mario Draghi said a couple of things the markets didn't like. Firstly, he said that the scale and scope of the stimulus was required in order to avoid disastrous deflation. He also said it was unlikely they could stimulate the economy more by dropping rates any further. So we've moved from an environment where central banks dish out cheap funding and money, and the markets take that, go out and invest in financial assets, driving up the prices and creating the wealth effect. Basically what's required for quantitative easing to work. To an environment where markets are skeptical about why they're receiving all this quantitative easing and instead hoard the money and render QE largely ineffective. This is not the first time we've seen this kind of reaction. In September last year, the US Fed kept rates on hold, surprising the markets, which initially rallied and then fell 6.5% in the few days that followed. Earlier this year in January, the Bank of Japan cut rates into negative territory, surprising the markets. The Nikkei initially rallied 4.5% and then dropped 15% in the 2 weeks that followed. So as central banks lose their ability to stimulate the economy via monetary policy, the real economy really needs to start standing on its own 2 feet. We need companies to invest in productive capacity, increasing the demand for capital goods. This should also increase the productivity of the labor force, who in turn will be more comfortable about their future earnings and go out and spend, increasing the demand from that side. If you have any more questions about this, feel free to reach out to us or read our paper on the topic. Thanks.